Well, it became, as you know, it became probably the most popular capital raising vehicle in the marketplace. I think certainly we saw IPOs took off in a major way, but SPACs even greater.
That was Michael Beber. He's the chairman of the board at Exiger, and he visits with me today about the current state of SPACs, special purpose acquisition vehicles, some of the abuses that happened over the past couple of years, but more importantly, the positive aspects of SPACs and where they will be going in 2022 and beyond. It's a great episode. I know you'll enjoy it. Have you ever thought about the intersection of tax and compliance? Well, I had not until I did a 5-part podcast series on Taxman with Tracy Howell. Check it out on the Compliance Podcast Network. Hello, everyone. This is Tom Fox back for another episode, and today I have with me, Michael Beber. Michael is with Exiger, and we are going to have a kind of free-flowing conversation on the current state of SPACs, or special purpose acquisition vehicles, here in the U.S. So, Michael, first of all, thank you so much for taking the time to visit with me, and welcome back to the podcast.
Thanks, Tom. Looking forward to it.
Michael, the first time we visited on this subject, I was relatively new to this. You have been knowledgeable and involved with SPACs for quite some time, but they literally exploded on the corporate consciousness, I think, in 2020. And here we are in 2022, and that explosion of consciousness, I think, has abated. And also perhaps some of the shine or sheen may have also been dimmed a little bit. So could I first start by asking you what you saw over the course of the pandemic around SPACs?
Well, it became, as you know, probably the most popular capital raising vehicle in the marketplace. I think certainly we saw IPOs took off in a major way, but SPACs even greater. And literally in 2021, there were over 600 SPACs raising, close to $150 billion. So it really was a crazy time. And as you said, things have definitely settled down and changed. And I think, obviously, at the end of the day, there's reasons why things have changed, which I'm happy to get into with you. And then obviously, those changes are going to lead to a very different future.
Yes, exactly. That's what I'd love to be able to visit with you about, the changes in perception, the changes in regulatory focus, if that might be the right phrase, and then the changes in how they may be used going forward. So could we perhaps start with some of the changes in perception about SPACs, what people thought they were back in 2020 and what they may have changed into now already?
When special purpose acquisition corporations became super popular in 2021. It was really, they've been around for many, many years, well over 10 years. They became popular because it really was a simpler way number one, it was a great way for investors to put money to work, and it was a simpler way for companies to go public. And what happened was, if you were a traditional company that could go public in the normal course, you would, because the fee base that you would have to effectively assume in an IPO was much less than a SPAC. On the flip side, if you're a company that it was going to be more challenging to go to the IPO market, you were prepared to go through a SPAC because it was faster. And even though there was this promote, if you will, it was still worthwhile. And so what ended up happening is traditional companies with revenue and cash flow and predictability would go the traditional IPO route, and more venturesome companies like the electric vehicle companies, like the battery companies, these more venturesome companies that really, some of them were pre-revenue, some had minor amounts of revenue, but what they had was intellectual property. The SPAC vehicle was perfect for them because they could inherit a company that would have $200 or $300 million on the balance sheet, which could then be used to move the company forward. So that's why they became so popular in 2021, because of the availability of capital and the need for these companies to raise capital. the question then became is how are they going to perform? And I think that's where there was a lot of concern. And the concern ultimately was that these companies were startups. They were not mature. Their technology was still untested in many cases. And so that investors, particularly retail investors, institutional investors have the ability to look deeper into these opportunities and make their own assessments. I always have less concern about the institutional investor because, quote unquote, they probably know better or should know better. On the flip side, the retail investor really has a limited way of really understanding the company and what they're doing. And in the case of SPACs, the amount of disclosure is much less than what you would see in an IPO. So what ends up happening, of course, is that these companies didn't perform. Their stock prices went down dramatically. They may have gone through a period where, the stock prices, they typically go public at around $10 a share. And so in many of them, you'll see that, like in DraftKings, the stock price went as high as $60. In Quantum Scope, the stock price went as high as $84. And then, there was this reckoning that took place and the stock prices fell back. Some of them fell back to their SPAC levels, the $10 a share. Some fell below that. Many fell below that. And then others like DraftKings and Quantum Scope are still above their effectively their IPO price. But what ended up happening is you had this real day of reckoning, and I think that really caught the attention of investors, obviously, and it caught the attention of the SEC. And so the question then became is what's going to become of SPACs in the future?
Well, and that leads me to the next point I wanted to explore with you, Michael, which is the SEC. Obviously, we had a change in administration and a new SEC chair come in who I think had at least different views than our prior chair, Jay Clayton. Our current chair is Gary Gensler. What did you see from the SEC, at least to date, around their comments on SPAC that has been notable to you?
Number one, they are very concerned about the retail investors involved in SPACs. Again, if you had only institutional investors taking advantage of this sort of swifter way forward to an IPO, I think it would be a different conversation. But the fact is retail investors got on board. And so I think that's what creates the concern in the first instance. I think in the second instance that they see that people fundamentally see the SPAC as a simpler IPO mechanism because the SPAC itself is the vehicle that went public. And when the SPAC is going to de-SPAC, it looks more like an S4 merger than it does like all the disclosures that you would expect to see when a company goes public in the first instance. So I think the first thing you're going to see coming out of the SEC is bringing the standards for SPAC demergers. The SPAC itself, there's not a lot more you can do because at the end of the day, what disclosure is there really? It's a blank check corporation that hasn't made an acquisition, is looking to make an acquisition. There'll be more disclosure around the backgrounds of the promoters of the SPAC. There'll be more disclosure around the fees and the associated relationship between the sponsors and the investment banks, and frankly the investors themselves, particularly if there's any potential conflicts of interest there. But I think overall, what we're going to see is a lot more disclosure around the merger partner, if you will, and exactly the company that's being acquired. Because at the end of the day, if you're an investor in a SPAC, in the first instance, you have the decision to make. You have a decision that you can make, which is whether or not you're going to allow your money to actually be used in that merger, or if you're going to choose to have it paid back. Whereas an individual buying an IPO, buying a company that's gone public through a SPAC, at the end of the day, does not have that determination. They really are just going out and buying the stock. And I think what the SEC has said is that they want a lot more disclosure that rivals the disclosure that these investors would see in an IPO, so that they're in a better position to make an investment decision. Whether that'll have a major positive change, that's a question that is worth exploring because I think there's certain other things afoot in the industry generally that I think will have very positive changes other than just more regulation.
Michael, we've also begun to see enforcement actions involving SPACs and some Delaware court cases involving SPACs. And the thing that struck me about both the SEC enforcement actions and the Delaware court case is these did not really take radical departures from prior enforcement actions or court decisions, that they tried to be consistent with prior precedent. And with the Tesla enforcement action, it was for conduct that occurred after the SPAC purchased Tesla, and then there was the de-SPAC. And then in the court case, the court really used sort of prior existing Delaware law to analyze the situation. If that's a fair assessment, would you see that trend going forward?
Yeah, look, I think you will. Again, what I would say to you is that the quality of the companies that are going to form parts of SPACs will be much, much higher in general. And that was really my comment a moment ago, is that I do believe there will be further regulation. I do believe that there will be a convergence, if you will, of the expectations for disclosures around SPACs being much more aligned to IPOs. But I also think that the general state of SPACs, in terms of the assets that they're going to acquire, are going to be much, much higher quality. So that you're going to see, right now, for example, you'll see that SPAC dollars raised will be used to fund operations more than anything else because, again, these were startups that SPACs are acquiring. Now I believe you're going to see that when SPACs make acquisitions, it's going to be much more traditional companies with revenues, with gross margin, with a level of they may be losing money, they may not be EBITDA positive at this point, but what they will be is they'll be companies that have clear trajectories. They have clear products in clear markets with clear customers, with addressable markets that are large, with growth rates that are proven. With more predictable revenue streams. So what I'm saying is I believe the quality of the companies is going to be much higher. I think there's going to be more regulation, but I think the convergence of those two will result in a lower level of needed enforcement that you might have seen based upon the mergers that we saw in 2021.
We're going to have a quick word from our sponsor, and we'll be right back. Michael, do you also see a maturity in SPACs themselves performing due diligence on these acquisition candidates as well?
It is a yes and no, and I'll explain why. So for the SPACs themselves, they will have raised capital, obviously, and that's what allowed them to go IPO, and then they'll have plus or minus 2 years to get an acquisition done. But a key component of success, meaning getting the investors to agree to allow their money to be used in the de-SPAC, because as you know, the investors have an opportunity to be refunded their money, and so they can actually turn down, even if the merger gets approved, the investors themselves can pull their money out and not be part of it. So what I think you're going to see a lot more due diligence is from what they call the PIPE providers. A PIPE is private investment in public equity. In order to get a SPAC done today, to prove up the price, if you will, it's not just enough to get a fairness opinion from an investment bank, but what you actually need is an investor independent of the investors in the SPAC to put up incremental dollars to actually buy the stock of the company based upon the price that's agreed with the selling company that's going to be part of the public vehicle. And so at the end of the day, these PIPE investors really have a big part of the due diligence burden because they're going to be actually writing a check and being part of the support, if you will, for the purchase price. So I think you're going to see one, much higher bar for the companies that are going to form parts of SPACs, and two, that the PIPE investors are going to do much deeper and broader due diligence to make sure that what they're paying makes sense, or whether they should do the deal at all. And then finally, this with a regulatory, overarching regulatory burden, incremental burden. I think those three things together will overall improve the SPAC market materially.
Michael, could you give us some of the key components that a PIPE investor might need to pursue in due diligence or looking into potential acquisition candidates, since these companies are typically private and there's no public reporting of any of their results?
It's a great question. It's going to in many respects, it's going to look like an acquisition that will have been done by any, if you will, when a publicly traded company does an acquisition, typically of another private company, they will enter into, full confidentiality agreement, a non-disclosure agreement that will have certain, rights and obligations to see and protect data. So there will be a full NDA process, and then there will be a full diligence process where they'll have to produce multiple years financial statements. They may have industry reports done around the total addressable market and the growth rate of that market. They can have quality of earnings reports done by accounting firms to vet the quality of the earnings that are being reported. They can do full background checks on the company itself and the management. So what you're going to see is that the PIPE investor is no longer just going to accept that the deal is at the table and that the SPAC itself has done work around the merger candidate. But in fact, they'll retain their own advisors and do their own work so that they can independently make their, if you will, their own acquisition decisions. So again, you're going to see it look a lot more like a traditional M&A process than you would have in the past.
Michael, at this point, are you upbeat around the use of SPACs? Because when we started, you said one of the key reasons for their literal explosion back in 2020 and 2021 was putting money to work. My sense is the money is still out there looking to be put to work. Would that be a fair assessment?
It is, but I think what's going to happen is that the attraction of a SPAC vehicle will be significantly reduced to a potential seller, because in a traditional IPO, there's a certain level of disclosure and roadshow, and there's a whole series of things that a potential, if you will, seller or SPAC merger candidate would go through in an IPO scenario, right? So a lot more work, a lot more effort, and so they would choose the SPAC route because it was much faster, and they would be okay with the promotional fee, the 20%, if you will, that the promoter gets, because again, they were a much more earlier stage company, really looking for the capital that would come with a SPAC. Now, because the standard's been raised much, much higher, the companies that would be prepared to sell into a SPAC are more likely to want to sell into their own IPO, because they are of a much higher quality. And so if they're able to do an IPO, they're going to say, well, why wouldn't I do that? And so I think there's a flight to quality to SPACs, but it's still going to be a company that's got to be a high growth, large market opportunity, high growth. Technology, I'm guessing, will be a bigger piece, but there's going to have to be much more visibility into it. So it has to be a higher quality company, but still one that finds the IPO route, as it's traditionally been, a little too onerous, and this might be seen as a more attractive route. But I will tell you, I think there's going to be fewer SPACs, and I think that of the SPACs that happen, fewer of them will actually get deals done, meaning investors will be more particular about backing out of opportunities unless it's really something great. And my worry is, if it really is something great, then why isn't the company going to go the traditional IPO route?
If a company is acquired by a SPAC and then moving towards the de-SPACing process, could the SPAC company bring managerial or executive expertise, much like we see in rounds of investment of private companies?
Yeah, I think that's a great question too, because what you saw with the original SPACs were, the people that were promoting them could be athletes, they could be entertainers, they could be all sorts of people that really, the quality of the promoter in the early days was really not scrutinized that well. Now, the SPACs themselves are, before they even go public, they're being the management teams are being scrutinized much more for much more detailed, deeper and wider expertise around the type of M&A that they are proposing. And certainly in my conversations with people that have successfully got a company public, not the D-SPAC, but I'm talking about the SPAC itself, when they're making their pitches to sellers, it's that we're going to be value added. So if part of your thesis is that you're going to want to do a series of acquisitions post de-SPACing because, for example, you live in a world where there's high fragmentation, or you live in a world where there's a whole series of subscale players. Whatever it is that's going to prompt you to do more SPACs, to do the SPAC. I think that the SPAC itself will make a case to the seller that they will have their sample, and you're selling into a marketplace where you see that there's a series of acquisitions that you could potentially make, including, from high fragmentation, or from, that there's strategic players out there that are subscale. There are strategic players that are in markets or have capabilities that you need. Whatever it is, the SPACs today will make a case that, not dissimilar to a private equity firm, that they could be supportive in executing on that strategy. So I think more and more, you're right. I think the SPACs are going to make a play to the sellers that they're value added and not strictly just a conduit to go public.
Michael, would it be fair to look at a SPAC or see a SPAC as one tool? That one tool is available for both investors and those looking to raise money in the capital markets that, depending on a variety of factors, may or may not be the right way to go, but if seen as a tool and properly used, it can be successful?
Yeah, I think that any company that is contemplating a form of recap or monetization, a SPAC has to be on their list as something to look at. It's just there's too much capital there to ignore. But as I said to you before, the bar is high, and there's this fee base, right? There's 20%. If a SPAC raises $200 million, plus or minus, there's a fee base of $40 million of dilution that any seller has to accept. It exists. And so, if you're a seller and your business is worth, $600 or $700 million, and there's $200 million of cash that's raised, that's a big base of fees. So, as I said, I think the bar is high, but it is a vehicle for sure.
Michael, unfortunately, we are near the end of our time for this episode, but I wanted to thank you again, and perhaps I could call upon you a little less infrequently in the future to talk about this most interesting corporate development.
Well, great. It was really nice speaking with you. Thanks, Tom.
This is Tom Fox. I hope you've enjoyed this episode of the FCPA Compliance Report. I also hope you will check out a special 5-part podcast series I'm running on the Innovation and Compliance podcast on Taxman, the intersection of tax and compliance. I visit with tax expert Tracy Howe on a variety of topics in this podcast series, including why tax should talk to compliance, why tax needs a seat at the table during contract negotiations, what is transfer pricing, tax and supply chain, and the role of tax and ESG. It's a topic that most compliance officers really don't spend enough time thinking about and working with the corporate tax function. I know you will find it incredibly useful. Thanks again for listening to the FCPA Compliance Report, and I hope you'll join us again next week.
This podcast is a part of the C-Suite Radio Network. For more top business podcasts, visit c-suiteradio.com.